Sandra worked for 28 years as a financial analyst at an insurance company in Columbus, Ohio. She understood numbers. She understood investing. She had spent her entire career helping other people manage risk, and she was confident that when it came to her own retirement, she had done everything right. She retired at 61 with a traditional IRA worth $580,000, a small pension, and a plan. The plan was simple, and she had read enough about it to feel certain. She was going to use the years between retirement and Medicare to convert as much of her traditional IRA into a Roth as possible. Pay the taxes now while her income was low, never pay them again. She modeled the tax brackets, she calculated the conversions, she consulted her CPA. She converted $95,000 in 1 year and $88,000 the following year. $183,000 moved into tax-free status. Her tax advisor confirmed she had stayed inside a reasonable bracket both years. She felt like she had finally gotten ahead of the system. Then she turned 65 and enrolled in Medicare. The letter from the Social Security Administration arrived 2 weeks later. Her Part B premium was not the standard $202.90 per month that her neighbor Linda paid. It was $365.60 per month. For both Sandra and her husband, that was an extra $3,290 per year in Medicare costs based on income from 2 years earlier. Income she had already paid taxes on, income she believed was completely behind her. Her CPA had never mentioned it. Her financial articles had never connected those specific dots. She had done everything the strategy required and still walked directly into a trap that nobody had shown her existed. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Jack, and this is Retire Wealthy USA. Every week on this channel, we break down the tax rules, the retirement traps, and the strategies that protect your savings from the things most advisors are not explaining to their clients. If that is what you need, hit subscribe right now and turn on notifications so you never miss a video. Sandra's story is not unusual. It is happening to careful, informed, financially literate retirees every single year, because the retirement planning world does a reasonable job of explaining Roth conversions and a terrible job of explaining the age at which those conversions become dangerous. The strategy is sound, the timing is everything. And the timing rule that almost nobody explains clearly has a specific name, a specific formula, and a specific age attached to it that changes the entire calculation. That rule is the Medicare 2-year look-back, and the age that triggers it is 63. Before I explain exactly why 63 is different from every other age in your retirement, I need to make sure you understand what IRMAA is, because this entire conversation rests on it. Most people know that Medicare Part B has a monthly premium. What most people do not know is that the premium is not the same for every retiree. Medicare charges different amounts based on your income. Not your income right now. Your income from 2 years ago. In 2026, the standard Part B premium is $202.90 per month per person. That is what most retirees pay and what most retirement planning assumes you will pay. But if your modified adjusted gross income from 2024 was above $109,000 as a single filer or above $218,000 as a married couple filing jointly, Medicare adds a surcharge on top of that standard premium. That surcharge is called IRMAA, the Income-Related Monthly Adjustment Amount. And the most important thing to understand about IRMAA before anything else is that it does not phase in gradually. It hits in a cliff. Cross the threshold by $1 single and your entire premium jumps immediately to the next tier. Every dollar of the annual increase applies retroactively from January 1st of that Medicare year. There is no warning. There is no grace period. The letter arrives and the higher premium is already in effect. Let me give you the exact 2026 IRMAA numbers so this becomes completely concrete. At the standard tier, below $109,000 single or $218,000 joint, you pay $202.90 per person per month. At the first IRMAA tier, $109,000 to $136,000 single or $218,000 to $272,000 joint, the premium jumps to $284.10 per person per month. For a married couple where both spouses are on Medicare, that is roughly $1,950 more per year than the standard rate. At the second tier, $136,000 to $163,000 single, or $272,000 to $326,000 joint, the premium rises to $365 and $60 per person per month. A couple at this tier pays approximately $3,190 more per year than a couple at the standard rate. At the third tier, $163,000 to $195,000 single, or $326,000 to $390,000 joint, the premium is $447, $10 per person per month. A couple here pays over $5,800 more per year. At the fourth tier, $195,000 to $500,000 single, or $390,000 to $750,000 joint, the premium reaches $528, $60 per person per month. And at the top tier, above $500,000 single or $750,000 joint, the premium is $689.90 per person per month. A married couple at the top IRMAA tier pays over $16,500 per year just for Part B. The couple next door with the same current income but different income 2 years ago pays under $5,000 for identical Medicare coverage. Same doctors, same coverage, same hospital network. Completely different premium based entirely on a tax return that is already filed and already passed. That is the cliff. And it is waiting for every retiree who makes large income decisions at the wrong age without knowing the 2-year look-back rule exists. Now here is the rule that makes age 63 uniquely critical, and why I need you to understand this before you make another income decision this year. Most retirees enroll in Medicare when they turn 65. That is when the standard enrollment window opens and when the majority of Americans begin their coverage. Medicare uses the 2-year look-back to set your premium. Your premium in a given Medicare year is based on your tax return from 2 years prior. So the premium you pay in your very first year of Medicare at age 65 is based on your income at age 63. Not 64, not 65, 63. That means every income decision you make at age 63. Every Roth conversion, every IRA withdrawal, every stock sale, every rental property check, every capital gain. All of it lands on a tax return that Medicare will pull exactly 2 years later and use to calculate what you pay for coverage every single month, beginning the day you enroll. Age 63 is the year Medicare starts watching. Everything that happens in your financial life at 63 echoes directly into your first Medicare bill. Sandra converted at 62 and 63. The conversion at 62 affected her second-year Medicare premium. The conversion at 63 set her first-year premium before she even walked through the Medicare enrollment door. Both conversions were financially reasonable decisions for her tax situation in those years. Neither one triggered a significant income tax consequence because her bracket had room. But the IRMAA calculation and the income tax calculation are completely separate formulas. You can owe 0 additional income tax on a Roth conversion and still push your modified adjusted gross income over the IRMAA threshold and trigger thousands of dollars in extra Medicare premiums. This is the gap that costs retirees the most money. The tax advisor looks at the bracket and says the conversion is clean. Nobody checks the IRMAA threshold on the same income. The premium arrives 2 years later, and the connection to a decision made in a completely different year is almost impossible to trace without someone specifically explaining the link. Let me show you 3 retirement situations with real dollar amounts, so you can recognize where you or someone you know might be sitting right now. The first situation is Michael. He is 63 years old. Retired electrical contractor from Tennessee, he has a traditional IRA worth $450,000, and his wife Barbara receives a small pension of $28,000 per year. Their combined income before any IRA activity is $28,000, plus Michael's Social Security of $21,600, which comes to $49,600. Their tax brackets have enormous room. A financial article Michael read online told him this was the perfect time to convert aggressively. So Michael converted $175,000 from his traditional IRA to a Roth in a single year. His total modified adjusted gross income for the year, including the conversion, came to $224,600 as a married couple. That crossed both the first and second IRMAA tiers. 2 years later, Michael and Barbara enroll in Medicare. Their combined Part B premium is $365.60 per person per month instead of the standard $202.90. Together, they are paying an extra $3,890 per year in Medicare premiums based on income from 2 years earlier. Over the 2 years that look-back applies before the window shifts to a different income year, that is $7,780 in extra Medicare costs. Michael's Roth conversion was likely the right long-term strategy. His traditional IRA balance will generate much smaller required minimum distributions at 73 because he moved so much into the Roth. The tax-free growth over the next decade may well justify the cost. But if Michael had split that same $175,000 conversion across 2 years, $87,500 in each year, and kept his modified adjusted gross income under $218,000 in both years, he would have moved the same amount into Roth status and paid zero IRMAA surcharge. Same strategy, different structure, nearly $8,000 in savings. The second situation is Helen and her husband George, both 63. Helen retired early from a state government job in Virginia and receives a pension of $42,000 per year. George still does occasional consulting work and earns around $30,000 per year. They also have a taxable brokerage account that holds stock Helen's parents gave her years ago. The cost basis on that stock is very low, and they have been meaning to sell it for years. This year they decided the time was right. The gain on the sale was $85,000. Between Helen's pension, George's consulting income, and the capital gain, their combined modified adjusted gross income for the year came to $223,000. They were $5,000 over the first IRMAA tier for married filers. 2 years later, both enroll in Medicare. Their first-year premium is $284.10 per person per month instead of $202.90, an extra $1,945 per year together. Over 2 years, that is $3,990 in additional premiums from a $5,000 income overage that could have been avoided by simply selling $5,000 less of the stock this year and the remainder next year. Nobody sat Helen and George down and showed them that the stock sale at 63 had a Medicare consequence at 65. Their financial advisor helped them plan the sale. Their accountant calculated the capital gains tax correctly. The IRMAA dimension was never mentioned because nobody connected the age to the look-back to the premium chart, to the specific dollar over the threshold. That missing connection cost them nearly $4,000. The third situation is Frank. He is 63, a retired high school principal from Oregon. Frank has a modest pension of $38,000 per year and Social Security of $24,000. His total income is $62,000. He has a small IRA worth $95,000, but he does not plan to touch it before RMDs begin. He has never heard of Roth conversions. He does not own individual stocks. He pays his bills and lives within his income. When Frank enrolls in Medicare at 65, he pays the standard premium without issue. His income at 63 was well below every IRMAA threshold. Age 63 is not a critical year for Frank, and pretending otherwise would be dishonest. Frank represents the majority of retirees who live on fixed income sources below the IRMAA floor, and for whom this entire conversation is informational rather than urgent. But if you have a traditional IRA with a meaningful balance, a taxable brokerage account with appreciated holdings, the ability to control when and how much income you receive, rental property, stock options from a former employer, or any income source where the timing is a choice rather than a fixed deposit, you are not Frank, you are Michael or Helen. And the decisions you make at 63 will show up in a Medicare premium letter 2 years from now, whether you planned for it or not. Here is what makes age 63 genuinely unlike any other age in the decade before Medicare. It is not just the IRMAA look-back. It is the fact that 3 completely separate financial systems are all making competing demands on your income at exactly the same time, and each one wants something different. The first system is federal income taxes. At 63, most early retirees are in what planners call the gap years. They have stopped working, but Social Security and required minimum distributions have not started yet. Their taxable income is at its lowest point in decades. The tax system is saying, generate income now because the bracket has room and the opportunity to convert IRA money at a low rate will not last forever. The second system is ACA health insurance. If you retired before 65 and are buying coverage on the marketplace before Medicare begins, your premium subsidies are calculated based on your modified adjusted gross income. A couple who manages their income carefully below a certain threshold can receive subsidies worth $12,000 to $20,000 per year in reduced premiums. The ACA system is saying, keep income low, because every dollar over the subsidy cliff costs you significantly more in health insurance before Medicare even starts. The third system is IRMAA. Your income at 63 sets your Medicare premium at 65. The Medicare system is saying stay below $109,000 single or $218,000 joint, or you will pay a surcharge on every month of Medicare coverage beginning the day you turn 65. The problem is that these three systems are not designed to cooperate with each other. The tax system wants you to generate income. The ACA system wants you to suppress it. The IRMAA system wants you to cap it at a specific number that may be higher than the ACA subsidy cliff, but lower than what aggressive Roth conversion would require. Getting age 63 right means understanding all three systems simultaneously and finding the income level that optimizes across all of them for your specific situation. There is no universal answer. The answer depends on your IRA balance, your current income sources, what your ACA plan costs, how long until Medicare, and what your projected income looks like at 73 when required minimum distributions begin. But there is a universal mistake: making decisions about any one of these three systems without accounting for the other two. That is what happened to Sandra. Her CPA optimized for income taxes. Nobody optimized for IRMAA. The strategy was incomplete, and the bill arrived 2 years later. Now let me walk you through the complete IRMAA timeline so you can see exactly how the 2-year look-back follows you through every year of retirement, not just the year you turn 65. Your Medicare premium in 2026 is set by your income in 2024. Your Medicare premium in 2027 is set by your income in 2025. Your Medicare premium in 2028 is set by your income in 2026. This pattern continues for every single year you are on Medicare. The look-back never stops. It follows you through your 70s, through your 80s, through every year of retirement, for as long as you are covered by Medicare. Age 63 is critically important because it is the first year that directly affects your Medicare costs. It is the year the look-back window opens. But every year after that, your prior year income is still being used to set your current year premium. A retiree who is 74 today and took a large required minimum distribution 2 years ago at 72 is paying an IRMAA surcharge right now in 2026 because of income they had in 2024. The look-back does not care how old you are or how long you have been on Medicare. It simply reaches back 2 years every single time. This is also why Roth conversions done at 60 or 61 are so strategically powerful from an IRMAA standpoint. Income from those conversions is already 2 or 3 look-back cycles behind you before you even begin Medicare coverage. It never appears in a premium calculation. It never triggers a surcharge. It is simply gone from the IRMAA formula by the time Medicare starts watching. And this is why the most effective Roth conversion strategy for retirees in their early 60s is front-loaded. Convert as much as possible at 60 and 61 before the IRMAA window opens. Then be precise and deliberate at 63 and 64. Not necessarily conservative, but specific. Know exactly where your modified adjusted gross income sits relative to each IRMAA tier before you make any income decision and size every conversion, every stock sale, every IRA withdrawal to land on the right side of the threshold you are targeting. There is one more dimension of this that deserves its own moment, because it is the cruelest version of the IRMAA trap and the least discussed. When a spouse dies and the surviving partner files as a single filer for the first time, the IRMAA thresholds cut in half overnight. While both spouses are alive and filing jointly, the first IRMAA tier does not begin until $218,000 of combined income. A couple can have significant retirement income and stay completely below the surcharge. The moment one spouse passes away, the surviving spouse becomes a single filer. The first IRMAA tier for a single filer begins at $109,000. A surviving spouse with $150,000 in income was $68,000 below the IRMAA cliff as part of a married couple. As a single filer, that same $150,000 puts them $41,000 above the second tier threshold. Their monthly Part B premium jumps from $202.90 to $365.60 per person. That is an increase of over $1,950 per year from the exact same income, with no change in lifestyle and no change in Medicare coverage. Just a change in one word on the tax return. Roth assets built up before this scenario occurs are one of the most powerful protections available. A surviving spouse who can draw from a Roth IRA instead of a traditional IRA keeps their modified adjusted gross income lower as a single filer and can stay below or closer to the IRMAA threshold in the years following a spouse's death. Every dollar converted to Roth while both spouses are alive and the joint thresholds apply is a dollar that gives a surviving spouse more flexibility later. This is another reason why the years between 60 and 63, when most couples are still together and filing jointly, represent the most strategically valuable Roth conversion window in retirement. Here is your action plan based on exactly where you are right now. If you are 60 or 61, you are in the cleanest conversion window you will have in your entire retirement. Your income at these ages does not reach into the IRMAA look-back for your first years of Medicare. You have the most flexibility for Roth conversions, and you should be using it deliberately. Calculate how much you can convert each year while staying in your target tax bracket, and convert as aggressively as your plan allows. Every dollar you move to Roth now is a dollar that will never appear in an IRMAA calculation when Medicare starts watching. If you are 62, you are 1 year away from the first IRMAA critical window. Your income this year sets your Medicare premium at 64, your second year of coverage. Begin modeling exactly where your IRMAA threshold sits and what your projected income will be at 63. The 2 years of 62 and 63 deserve a coordinated plan, not independent decisions made without reference to each other. If you are 63 right now, stop before making any income decision for the remainder of this year. Pull out your most recent tax return and find your modified adjusted gross income on line 11 of your Form 1040. Calculate exactly where you stand relative to the IRMAA threshold for your filing status. For single filers in 2026, that threshold is $109,000. For married filing jointly, it is $218,000. Every Roth conversion, stock sale, IRA withdrawal, or discretionary income event for the rest of this year should be sized to land on the right side of your target threshold. Do not guess. Run the numbers or have someone run them before December 31st. This is the single most consequential financial deadline you have this year. If you are 64, your income this year sets your second-year Medicare premium at 66. The same precision applies. If you are already on Medicare and you are paying an IRMAA surcharge based on a high-income year that no longer reflects your current situation, check whether you had a qualifying life-changing event in the year that triggered the surcharge. Retirement, reduction in work, death of a spouse, loss of pension income, and several other events qualify. If one applies to you, file Form SSA 44 with the Social Security Administration. You can now do this online at SSA.gov. If approved, Medicare will use a more recent tax year to recalculate your premium. Most retirees who qualify for this appeal have never heard of the form. It is one of the most underutilized tools in the entire Medicare system. If you are on Medicare and your income consistently runs near the IRMAA threshold because of required minimum distributions, consider using qualified charitable distributions to reduce your modified adjusted gross income. If you are 70 and a half or older, you can transfer up to $115,000 per year directly from your IRA to a qualifying charity. That transfer counts toward your required minimum distribution for the year, but it does not count as taxable income, and it does not count toward your MAGI for IRMAA purposes. The distribution is invisible to the IRMAA formula. A retiree with a pension of $55,000, Social Security of $24,000, and a required minimum distribution of $18,000 has a MAGI of $97,000 before any investment income. If a stock dividend of $15,000 pushes their total to $112,000, they cross the first IRMAA tier. If instead they route their $18,000 RMD as a qualified charitable distribution to a charity they were already supporting, that $18,000 disappears from their MAGI. Their total drops to $94,000. They stay below the threshold. Their Medicare premium stays standard, same retirement income, same charitable giving. One routing decision worth nearly $2,000 per year in avoided Medicare surcharges. Here is what I want you to understand about why so many careful and informed retirees still get caught by this. The rule is not hidden. The IRMAA look-back is public information. Medicare publishes the tier chart every year. The Social Security Administration explains the formula. The problem is not that the information does not exist. The problem is that nobody presents the specific interaction between age 63 and Medicare enrollment with enough clarity and urgency to make the consequence feel real before it arrives. Most people who get hit with their first IRMAA surcharge had a financial advisor during those years. Many of them did Roth conversions with their advisor's full knowledge. The advisor looked at the tax brackets and confirmed the conversion was reasonable. The IRMAA calculation was either not raised or not explained in a way that connected to the specific income amount in the specific year with the specific dollar consequence 2 years later. The strategy was right. The age-specific precision was missing. And in retirement finance, missing one dimension of a multi-system interaction is all it takes to hand thousands of dollars to Medicare that were never supposed to leave your retirement account. Sandra paid an extra $3,190 in her first year of Medicare based on conversions she made at 63. The following year, the look-back shifted to a different income year, where her MAGI was lower and her premium returned to the standard rate. The surcharge was not permanent, but it was real, it was avoidable, and nobody had shown her the connection between the age, the conversion, the look-back, and the premium before she made the decision. You now know that connection exists. The question is whether you act on it before December 31st of the year you turn 63 or learn it the way Sandra did. From a letter that arrives 2 years after the decision is already made. This is Retire Wealthy USA. If this video showed you something your financial advisor has never explained, hit the like button right now, subscribe, and share this with anyone you know who is in their early 60s and has a traditional IRA. They need to see this before they turn 63. Drop a comment and tell us whether you knew about the 2-year IRMAA look-back before watching this video. If you are already on Medicare and your first premium surprised you, tell us what happened. We read every single comment, and the most common situations become the next video on this channel.